Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show.
Thanks, Jim.
How can people afford to live anymore? Mortgage rates going nuts. Meals at the pub that used to be $10 2 years ago are now $22 or $25. How can the regular person get by?
Yeah, it's crazy, isn't it? My daughter went to the expo in the X in Toronto last weekend. She told me that they were selling cobs of corn on the grill for $14 a cob. I thought, wow, that's a margin, because you could buy those for about 50 cents a cob in the retail, so just raw. So anyway, I think it's been a hell of a good excuse for a lot of price gouging the last couple of years. This whole justification that inflation's out of control and the costs are out of control. And, I kept saying, well, what are we going to do with these prices then when the costs are not out of control, when things are coming down and demand is receding? Are you going to reduce the prices then as well? And of course, most of the time, especially in services, they tend to be sticky, and no one likes to reduce that. But a good old-fashioned recession or big demand decline often will finally work its magic, but it takes quite a while to work through the system. So I agree that right now, everyone was saying for the last, 16 months, 17 months, that the consumer was fine, Jim. The consumer was fine. Amazing. The central banks have raised interest rates at the fastest or most abrupt clip in, 40 years, and the consumer's fine. Look, they're still spending. Well, of course, there was a few factors there. One was the drawing down of the pandemic era stimulus that all piled up in bank accounts there for a while. The U.S. savings rate in 2021 at the peak went to about 32%. But the problem is that money has been spent with both arms and both legs for the last couple of years, and all that was was run down as interest rates started to climb. And we know that a huge amount of mortgages were locked in when rates were really low. That is one unique feature of this cycle. I think, in the last cycle, Greenspan cut rates at the very bottom to 0.25 and left them there from 2 cycles ago, from 03 to 04. He left the base rate at 0.25 for a year. And that was hugely stimulative for a little while and led to the subprime mortgage crisis and the big escalation in U.S. home prices and then the big crash that followed. And you think about it this time, and they had, ultra low interest rates for about 12 years, and they pushed them down to 0 during the pandemic crisis. So that was really this sort of unprecedented period where people were able to add debt. Every time something came up for refi, they could, reduce the cost of carry, and that really was a huge wind at the under the sails of the economy for a little while. But just like in the 2003 episode when that sort of enabled unsustainable spending and demand and credit consumption, we're seeing the unwinding of this really, truly epic period now in spades. And we kept saying that, guys, it works at a lag. It's multi-month. It typically takes, 18 to 24 months for these higher rates to start hitting, because not everything is on floating rate debt. A lot of stuff is locked in, comes up for renewal, in tranches over time. So that's actually starting to really whack now because consumers are, especially in Canada, as you know, it was quite popular to have 5-year fixed rates. And when rates were, less than 2% there at the very bottom, mortgage rates were less than 2% in 2022, early 21. People did lock in for, 2, 3, 4, 5-year terms there. But we know that a bunch of that is now coming up for renewal. At the same time, of course, all the floating rate debt, so the lines of credit. I was just checking out of interest, lines of credit for prime customers are now, consumer lines of credit are almost 12% today, Jim. And the banks are now, of course, one of the horrible impacts of the rate cycle that we've been through is that a lot of people were in floating rate debt because that was the cheapest rate for a long period of time. So they've been whacked already in terms of, that cost has just galloped higher quarter after quarter for the last, 17, 18 months. But also things like negative amortization, which we've discussed before, where the banks said to, don't panic, we won't make you increase your payment, just pay the same amount you're paying, even though the interest cost has gone up exponentially, we'll let you keep paying the same payment. Well, all that's done is created, about 25% of the mortgage book now at the major banks is negative amortization mortgages, where the balance has been rising as people have been sort of extending and pretending and trying to keep payments the same in this world where interest costs were galloping higher. So that's been really a very dangerous episode, and of course the bank regulators are now cracking down and causing the banks to send out letters to their customers saying, hey, if you're in a negative amortization situation, if your amortization period is, more than 25 years, and some of them are out to 90 years, like it's just basically debt forever. It's never going to be paid off. They're wanting them to rein that in and structure it and put it back into some kind of a 25-year amortization payment. So all of this is really to say that housing affordability is the worst it's been since at least 1980. No one's seen anything quite like this. We've already seen the average sale price in Canada come off from the peak, which was about $855,000 in March of 2022. The benchmark price is now about $750 nationally, and we know that the mortgages that are coming up for renewal in 2024 are going to see at least a 25% increase in their payments. And so what you're really noticing is wobble all over consumer demand, retail spending. It's quite remarkable. I mean, Canadian Tire, of course, warned this month, but, Target, Home Depot, Lowe's, Macy's yesterday. Macy's is supposed to have a sort of a more affluent customer. Their shares tanked because they warned that demand is plummeting. At the same time, anyone that's got credit cards, so Macy's has, customer credit cards, and they're seeing this big jump in delinquencies on credit cards. Canadian Tire also is seeing the same thing. The year-over-year growth in credit card delinquencies is about 45%, Jim. That's like the highest since 1992. Much higher than we saw increase even in the 2008 recession. So this is across, this is not just in the United States, this is in Canada as well. As we know, we've got this, nearly $3 trillion of household debt in Canada. A lot of that has faced higher rates already or is coming up as these renewals come due. 63% of homeowners are saying 63% of homeowners with a mortgage say they're financially distressed. Well, we know that more than 70% of Canadian homeowners have mortgages. So this is all a major thing. And this is, as I've said many times, we've only seen unemployment move up a little bit so far. We're only at about 5.5% in Canada and, about 3.5% in the United States. These are still historically very low unemployment rates, and we know for sure that they're going to move higher over the next year and so because that's the target of these central banks. They're specifically raising rates to try and crush the amount of employment and income in the economy so that they can constrict the amount of spending going on. So they've done that both through the credit cycle, but invariably that also means we're going to see a downturn in the amount of employment. So all that is sort of like this recipe for hell on wheels. And now we've got student loans in the U.S., which are going to start being paid in October. So we've got all these defaults and stress showing up across the retail sector, negative retail sales, which is, again, a major precursor of recession, very reliable historically. And the average student loan payment is going to be $300 a month, and that's not just students that make those payments. It's a lot of parents are, on the hook or promise, if you get the loans, we'll help you pay them back kind of thing. So I think that's all to say, why the household is so distressed. We know that household spending or consumers drive about 70% of U.S. GDP growth. 55 to 60% of Canadian GDP growth is premised on all that. So when we've got these major retailers all warning across the board and their stocks are crashing because they're, disappointing on, some are having to cancel their dividends because they're seeing this very difficult period. Of course, a bunch of them borrowed their brains out during the low credit era now as well. Even small business or medium businesses that don't float debt in public markets, their loan demand is at near the 2008 lows right now, and that's not just in North America, that's in Europe. So we've really got this, problem of high carrying costs and these very high debts are causing a contraction worldwide in the economy. We're seeing it in China as well. So the question is, where is the growth drivers going to come from when all that is in major distress? And of course, U.S. banks and Canadian banks are all negative year to date because they're now, Canadian banks are starting to report their latest earnings as well. But they've got higher costs across the board, much higher costs in terms of their expenses. They've also got much higher cost of capital when they try to borrow at the overnight rate from central banks, just as they're seeing this big jump in bad debts and charge-offs. So we're in for a very challenging period in financials. And, of course, that all bleeds through in Canada in particular because 32% of our TSX index is actually Canadian financial shares. So the fact that when the financials are faltering, it's always a warning sign for the overall market.
Now, insurance costs with devastating fires in British Columbia, Maui, the poor people of Lahaina. What's this going to do to homeowners and condo strata councils? Insurance is already sky high. Some places can't get insurance, and if you can't get insurance, you can't sell your condo. What kind of an impact do you see happening with, the design of homes? Do they have to be more flood and fire resistant?
I think this is really a major issue that's been largely underreported or unnoticed. I get mail from people who tell me they disagree with the climate thesis. Listen, this is the property insurance market across the world. It's not a question of whether you agree or disagree. The math is such that the chaos being created by fires and storms and winds and rain and floods and all this stuff, it's literally off the charts. And the reality is that these insurers are already pulling back in many markets, or premiums have escalated by tenfold. And so I'm just simply asking the question, and I'm thinking about it even ourselves personally. If you have a bunch of your net worth in real estate, and it doesn't have to be just in Canada. I mean, this is a global phenomenon that's happening. And it used to be that, the way reinsurance works, the way insurance typically works is that, companies will underwrite different parts of each other's books to spread the risk, so to speak, to spread the cost, so that if there's, if you have exposure to a wildfire in one area, well, that's, you pay that out, but other companies don't have exposure like that, so they can, help share the cost of that with you. Well, in this scenario, it's everywhere all the time, right? So every other week we're getting some catastrophic event, and we have had severe consolidation, by the way, in the insurance sector over the past 15 years. So there aren't that many global players now. There's, a few, and they are being hit from all sides on these catastrophic claims, just at a time when, don't forget, real estate values have become so extraordinarily elevated worldwide. So we have so much of the world's net worth. I mean, most 75% plus of Canadian household net worth is in real estate. So I go back to, if you can't get insurance on an asset, how will that shape your thinking or your allocation choices? And I think it will do so in profound ways. I mean, I think that your idea that it's nice to have a couple of $1 million in some, fancy house in one spot, will shift to, hey, maybe we want to have, a couple of more modest abodes, maybe one here and maybe one over there, much smaller and easier to repair or to rebuild if something happens to it. And I think that that's really going to be an interesting counterbalance to this time again, where low rates built monstrosities, mansions, overbuilt the property sector so much because, again, it was so cheap to do so, and everyone, thought square footage was the bomb. I think this is the antidote to that, where we're sort of thinking, let's rethink that. I think it goes back to similar characteristics with respect to your health, and this idea that, doesn't matter what you eat or what you do, lifestyle, or how you treat yourself, because you've got this, government-funded healthcare plans to fall back on, or even if it's, private insurance companies to fall back on. Well, what if the health costs become so great that we're not able to fund that, and all of a sudden you're putting more responsibility back on the individual to self-insure? And I think that is probably going to be the trend in all kinds of insurance going forward from here, and ultimately that could be a very actually sobering, leveling kind of an input. It could be actually very healthy in shifting our biased behaviors and activities towards more constructive, productive things, taking again more responsibility for our own initiatives rather than sort of prolapsing onto this expectation that insurance has got your back. But in the meantime, it could be a major shifter in the whole, another thing to sort of pop the housing market, so to speak. And I think that's a major factor we should keep an eye on.
Yes, building a fire-resistant home or one resistant to tornadoes. I saw after a devastating tornado in the States in the Midwest, they said it's impossible to build a tornado-resistant or proof home or building. And I had friends from Miami watching that, and they said the walls of our place are 2 feet thick. We have steel shutters. We get hurricanes and tornadoes all the time. We lost some bushes. Our house is still there. Yeah, you can build, for these disasters.
Sure. And I mean, it used to be, again, there were certain areas that were very prone to flooding, for example, and people would say, well, can we really afford to let people keep rebuilding in these high hazard zones, in these flood zones? Well, again, back when maybe a couple or 3 areas in a country were prone to this kind of flooding periodically, that's one thing. But when all sorts of places are being subject to these, extraordinary loss events, repeatedly every year, that's quite a different scenario altogether. So again, I think you're right. I think it shifts our idea of what a safe or reasonable or, rational abode is to build, both in terms of structure, in terms of construction, and in terms of location, in terms of size, all of that. So it's definitely a really big element, I think, that's not going to go away.
Well, I think Abbotsford found the mistake. They drained an ancient lake and built a city there, and were horribly flooded a few years ago.
There's a good amount of that, and then there's a huge amount of randomness as well now because of the overall climate chaos, as I like to call it.
Yeah, and with these rampant wildfires, cut back the bushes. And why isn't it mandatory to have, say, a 500 or 1,000 gallon tank tower that would feed by gravity to keep your house covered in water during a fire event if you're in these fire zones? Why isn't that part of the building code? It wouldn't cost much more if everybody was doing it.
Well, I mean, I'm not an expert on how best to structure construction of these things. I'm just an analyst, a financial analyst looking at the math and the numbers, and I can just see the issues there.
But if you're going to rebuild there, maybe consider a home like that.
Maybe. if that's recommended by the experts.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Danielle Park. Danielle, I know we've sounded maybe a little negative in today's show, but there's got to be a ray of sunshine somewhere.
Oh, I think there's lots of rays of sunshine. Yeah. I look at it this way. We've been doing a lot of very non-economically intelligent things. A lot of destructive things, a lot of things that have hurt our productivity and overall health. And I think that this is a tipping point. Neil Howe calls it the fourth turning, whatever you want to call it. I do think we're at a point where fundamental systems, behaviors, and thinking are in a transition phase, and necessarily. But the upside of that is that I think there is a lot of opportunity for doing things smarter, for strong hands to actually, lead and to step in and to recycle, reuse, repurpose, whether that be transitioning gobs of empty office space to more efficient residential housing, whether it be downsizing some McMansions, whether it be, people learning that debt is actually a waste of capital and that living within your means is a much more sustainable way to go. I think that, that's all part and parcel. And now we've really, at the moment, we've got this huge, so as I've said, the effects of the Fed hiking cycle or the hiking cycle that's happened in most of the developed world is going to continue to drag down economic output and growth over the next 12 months for sure. It really starts to pick up in about this coming into the third and fourth quarter, accelerating into sort of over the next 6 to 9 months is when we should see the bulk of the weight of the rate hikes hitting the economy. So the good news there is that the stock market sort of, despite all its mania and speculation and madness, has actually seen this coming to some extent, because if you look at the numbers, the S&P, the NASDAQ, even with all the AI mania in a handful of stocks, which were propping up the S&P and the NASDAQ, the stock market there is at the same level as August of 2021, Jim, so 2 full years of going nowhere. The TSX is the same as June of 2021, so even longer there in terms of flatlining. The Chinese stock market is negative 16% since it peaked in October of 2021. So what I'm saying is we're in the midst of a bear market that's ongoing. It's been, populated by these dramatic reversals and manic episodes again, where people have been piling into all the sketchiest companies. But that's just because behaviorally they didn't learn significantly enough in the 2020 quick down and right back up with lots of government handouts. They didn't learn to curb those behaviors and become more productive in what they were doing. So we've seen now 1.6 years basically without any new cycle high in the stock market. That's only happened 7 times in the last 70 years, and all those occurrences were in the context of a major ongoing bear market that didn't bottom for many months after that. So I think like tonight is NVIDIA's earnings announcement, and you've got all this hype around, is NVIDIA that as the AI poster child, is it going to save the day? Well, NVIDIA is trading at 237 times its trailing earnings. So even if it surprises to the upside, it is unlikely to be worthy of that kind of extremity in its valuation. So I think what we're talking about here is the most egregiously valued stocks relative to things like treasury bonds, which again are at the highest yields in 23 years. You can get these more than 5% on treasury yields and the safest deposits today. That's much more attractive than stocks trading at these nosebleed levels. And whenever, if you look at even like a global index or the Wilshire 5000 versus treasury bonds, we're at a higher overvaluation in stocks today than we were at the dot-com peak just before the crash, way higher than the financial crisis peak in 2007. So my point is that there's great opportunity in the making here in terms of the setup for stocks. As this next, say 6 to 12 months of rate impact moves through and does its usual, which is cleaning out the chaff and, rewarding the strong hands and punishing the weak. That's the normal cleansing process that goes on here. We're in the midst of one of these that we haven't really seen in earnest since 2007-8, and that set up phenomenal opportunity after that episode as well, when stocks came off so significantly. Yields were the best we'd seen in 15 years, and risk was much lower than when prices were off the charts. So I think you've got that. At the same time, as I say, Treasury bonds have been beaten up too. They've had a hard go the past 2 or 3 years as rates went from nothing to, now rapidly to more moderate range. But there's good opportunity in that too, because we know that, first of all, new money that's getting reinvested or rolled over is getting compensated with very attractive yields, but also that the beating up part that's happened on the bond market is set it up for this big rally phase. So when we know that when we get into the cutting part of the market, that's when the Treasury market has always rebounded and gained significantly while everything else is tumbling on the risk side. And that's why when you look at that long-term chart of, as I say, the stocks versus bond ratio, you see that stocks come off significantly and bonds rise during that period, and that's how you get a normalization in that sort of long-term mean. So we've got great opportunity set up here. It's a function of maintaining your liquidity and your wits about you. It's a function of knowing what to expect, as these forces mean revert, where the value is going to be uncovered, and to try and have some plan of action devised in advance. So if you can do all that, I think it's probably one of the most exciting investment setups that we've seen in many decades. And that could, like I said, it's going to impact all asset classes. I think real estate is in for a major repricing cycle. It's already begun, but again, it's slow moving and it's been truncated or slowed down by the amount of fixed rate mortgages that had not yet come up for renewal. But that's no small and trifling factor, and we're already seeing the leading edges of that all over the place. So I think that it's just a function of being patient, being well-positioned, having a plan, and understanding what's going on.
Danielle, thank you so much for chatting with us.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. If you have any questions for Danielle or for any of our guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.